Liquidity is one of the arguably most important concepts when trading. Whether you recognize liquidity or not, it is ultimately what is moving the markets. So liquidity, from a basic financial definition, refers to the ease with which an asset or security can be converted into ready cash without affecting its market price. So what that basically means is being able to convert one currency into another without inversely affecting the price. So when we think about this in the most simplest terms in trading, liquidity is literally everything. Orders in the market are really the source of the liquidity that we're seeing. The market is in a constant battle between supply and demand. Supply and demand is exchanging, and at the end of the day, at any given price on a price chart, there are orders. People are looking to buy, people are looking to sell. It's no different than if we look at, say, a grocery store, for example. If you're buying something like strawberries, you might get a bushel of strawberries for $5, but another vendor has a bushel of strawberries for $6. More than likely, people are going to flock to the $5 price, but as soon as those $5 sell out, but there's still people looking to buy strawberries, they'll go to the $6. And this is what's happening in the currency market each and every day. The only difference is it's not offered by a small local vendor. What's happening is there are orders at various price levels willing to be facilitated for the purpose of transactions, for the purpose of liquidity. Because when you've hit buy or sell in the markets, I'm sure your order was able to go through instantly. Why? Because there was liquidity or orders to actually match your order. For every buy order in the market, there needs to be a sell order on the other end. And for a sell order, there needs to be a buy order. It's the battle of fair exchange and supply and demand. And the reason why price is moving up and down in a constant flow is it's moving from pockets of liquidity to pockets of liquidity. And what we need to visualize on a chart in more of a conventional manner is the fact that what we're seeing is just simply orders on a chart. We're seeing it depicted graphically via candles, but at the end of the day, every single price point that we see, every single pip is a potential price that an order is sitting at. And the reason why price is moving up or price is moving down is to balance the amount of orders that are resting in the markets, to find a stance of liquidity to create that balance. Because in fair exchange, price will remain constant or relatively stable, but as soon as there is an imbalance between demand or supply, that is when price will move rapidly either up or down to rebalance price to get it back to a state of liquidity where orders can very simply be converted into cash without inversely affecting the price. So with all of that said, there's a couple different aspects of liquidity. It goes much deeper, but these are more so the basic components of liquidity that we'll be focusing a lot of our attention on as we navigate the charts and as we continue to move forward. So if we're looking at very basically swing structure or any sort of market structure that's being printed in the markets, what we see is once that market structure has been created, whether it's a swing low or a swing high, more than likely there are going to be orders that rest just above the high or just below the low. And those orders exist for a multitude of different reasons. In a basic sense, anyone who would have sold at this swing high would have their stop loss just above the swing high. Anyone who bought at the swing low would have their stop loss just below the swing low. If we're looking at people who trade breakouts, there would be orders to execute when price breaks down below. So there'd be orders here. Same thing if people are trading the breakout to the upside, there'd be orders waiting here for price to break to the upside. And simply put, depending on what the price level is, there might just be orders sitting at these areas, and once price tapped in just above those pools of liquidity or these pools of orders that exist, it was enough to take price away because there was an imbalance between buying and selling, and price will more than likely return to these pools of liquidity at a later point once a new imbalance in the market exists. Because at the end of the day, price moves to find liquidity to rebalance the market, or in other words, price moves to find orders to rebalance the market. Price is moving from one price to another price for various reasons, but price moves based on the imbalance between supply and demand. All that is happening on this chart is people are buying and selling. There are orders that exist at all price points. These orders need to change hands. For buyers, they need sellers. Sellers, they need buyers. And it's this constant battle between the two that's causing price to reprice, targeting different liquidity pools or groupings of orders at various price levels. So when we're looking at that swing structure, when we see swing highs, swing lows, or any bits of structural points of market structure, and the fact that we just finished the market structure section, this will be fresh in your mind. Think about all of those swing highs and swing lows that are created. There is liquidity that rests above and below those swing structures, again, for a multitude of reasons. One thing I want to make entirely clear as well, there are many thoughts within this realm of thinking of liquidity, that the liquidity is created for the sole reason to be taken, or price is manipulated to run stops on swing structure, or what we'll touch on these to the right, is that these patterns, so to speak, are created simply to run liquidity. That's not simply true. There really isn't a entity that is out there to steal your lunch or manipulate you at a price. It's just simply due to the fact of supply and demand and the order flow that's going on behind the scenes. Again, when we're looking at a price chart, the candles are simply depicting buying and selling. That's all it is. They're depicting what's happening to price at a given price level, and the interaction between supply and demand is what's going to give us our bullish or bearish price. The reason why price is going up or down is really just facilitated through how that transactional flow is actually happening on the charts. So while it may be well and good to say that a large institution is looking to liquidate and take out all the stops before it runs, that's not really the case. What it bogs down to in many cases is that there is a algorithm of some sorts that is run by central banks, things like that. We live in the information age where AI and computers run a lot of the things we do. Why wouldn't they be in the financial markets? And what their job is to offer buying and selling to the parties that are looking to buy and sell at various price levels. With that understanding, once price sees an imbalance, it's going to start to move. Where is it going to move? It's going to move to where a large collection of orders are that will rebalance price. So in this case, with this swing structure, this swing high, once we get some sort of imbalance down here, the next logical step that price is more than likely going to go when there's an imbalance is to where more orders exist. It'll tap into that, it'll rebalance price, and then we might see a move back to the downside, because price has facilitated that imbalance and we've continued moving. And it's the same thing with this swing low here as well. We get an imbalance, price dips into this liquidity pool, or this large pool of orders. It rebalances price. It finds that flow between buying and selling, and then price again moves in the opposite direction. Why is it doing that? Because we rebalance price on the low end. Now we need to rebalance price on the high end. That is what price is doing. It is just rebalancing. It's doing its job, creating a fair marketplace given supply and demand. It's providing liquidity, which is just the ease to transfer an asset to cash. And that's what it's doing time and time again. What we're doing with this understanding of swing structure, relatively equal structure, and trend structure is just understanding where logically these large pockets of orders are likely to sit, so we can have a better indication and understanding of where price is likely to go when it's trending, when it's pulling back, and just understanding the flow of the market. So now that we talked about the swing structure, the highs and the lows, we can look at relatively equal structure, because this is just an add-on to the swing structure, because now what we have is a double top and a double bottom. And if you've traded any sort of previous strategies, a lot of the basic things that we learned was buying at double bottoms and selling at double tops. And when you did that, where did your stop losses go? Well, if you were selling at a double top, you'd put your stop loss above the highs, and if you're buying at a double bottom, you would put your stop loss just below the double bottom. That's basic knowledge. Everyone knows that those orders exist. And again, we can look for breakout traders that have their orders sitting here, breakout traders that are having their orders sitting here. At the end of the day, what does this translate to in the simplest terms that we possibly can? There's a big pool of money here. There's a big pool of money here. Orders, just think of it that way. There are a lot of orders sitting here, whether they're stop losses, whether they're buy stops, whether they're limit orders, you name it, they're there, because everybody trades different. Everyone has a different reason for buying price. It might be large funds and institutions, it might be small retail traders such as us, it might be algorithms that are simply just offering buying and selling at different price points. But all we need to understand is when we see these sorts of structures is that there's just a large collection of orders that are resting here, and that price is more than likely going to be gravitated to these areas. Why? Because it needs to rebalance price to provide liquidity to the markets. Again, what is liquidity? Liquidity is the ease with which an asset, security, financial instrument of any kind can be converted into cash without affecting its market price. So what does that mean? It just means that you can buy and close your position, or sell and close your position, or just be able to execute a transaction, that there's someone on the other end of your transaction ready and willing to exchange with you. Because like I said, and I'm going to repeat this probably a few more times, if you're buying, someone needs to be selling. And if you're selling, someone needs to be buying. There needs to be two parties involved in every single trade that you're involved in. Now, of course, when you start factoring in lot sizes or units, this is where the fun begins, because I might be buying one lot of currency, someone might be selling 100 lots. So I've been able to buy one lot of currency from this 100 lot sell. They still need to fill their 99 lots. Liquidity is what's going to allow that to happen. But if that person can simply not facilitate their order, their 99 additional lots, that's where price is going to, you bet it, going to seek liquidity. It's going to rebalance price. It's going to find more orders to facilitate that transaction. That is all price is doing. It's moving from one pocket of liquidity or one pocket of orders to another, rebalancing price, because people are buying and selling constantly. People are buying and selling at different sizes. And for everyone that needs to buy, there needs to be a sell. For everyone that needs to sell, there needs to be a buy. And that constant balance in the market is what provides the liquidity, and it's also what causes the market to continue moving up and down. So now that we've looked at that, we can look at trend structure a little bit more. And what we can see is it's a combination of swing structure, relatively equal structure, because as we're seeing, we have this downward sloping trend structure. And I'm sure when we first started trading, a lot of us jumped into trend lines and pattern trading. And one of the things that we learned is when we had two lower highs in succession, we could draw a trend line and we'd be looking to trade the third touch, as that would be a validated trend. If you did that, where would you be putting your stop loss? Somewhere above the previous swing highs. Same thing if it was an uptrend, you'd have two higher lows, and the third one you would be looking to enter. Where would you be putting your stop loss? Below one of the structural higher lows. So we know, just given that in its basic sense, what is being built above this? Orders. A lot of people are also looking to trade breakouts. So again, all of these go back to the exact same thing. What is happening? What is being created? Big pockets of money, big pockets of orders. That's all that's sitting above these swing highs, these relatively equal structures, these trend structures. Why? Because price needs liquidity to move. Liquidity is the ease in which an asset or security can be converted into cash. For every buyer, there needs to be a seller. For every seller, there needs to be a buyer. And in order for that to happen, we need orders. And if there aren't enough orders to facilitate all of those orders, price needs to rebalance, or we need to see a reprice. And that happens with price moving up or down. Again, like I said, I wanted to repeat myself, and I said I would repeat myself several times, because it's this basic concept that makes liquidity and understanding liquidity incredibly powerful. Because when we pair this with market structure, when we pair this with supply and demand, we have a full sense of understanding of what's happening on the charts, because we know we are trading supply and demand. We are looking for the imbalances between supply and demand. We also know that we use market structure as our basis of understanding trend and where price is likely to go. We pair that with supply and demand. We start to understand that when price is forming a higher low, for instance, that we'd be looking to buy at demand zones to then take out the previous higher high to form a new higher high. We can now take that a step further, because we understand that price is moving from one price level to another price level to facilitate transactions, rebalance price, and offer liquidity. Liquidity is what's moving the market, because simply what we're doing is converting an asset to cash. And the only way to do that is by moving from order to order, balancing supply and demand. We're looking for imbalances in supply and demand to trade the supply and demand zones, but we need to understand liquidity and the areas of liquidity that are being created, being run, so to speak. And again, when I use the term being run, that really just showcases the collection of orders being tapped into before something happens. And what we might see is that price would run liquidity and then run the other way, or what we might see is price creates liquidity and then continues on. And we can use liquidity for a basis of building trade ideas, or use liquidity as targets as well. And we'll dig into those sort of components in the next section when we dive into internal versus external liquidity. But one of the biggest things is really just understanding from a conceptual standpoint what liquidity actually is in the markets, what it represents, and what's actually happening behind the scenes. Because again, price is only moving up and down to facilitate orders. That is all that's happening on a chart every single day. The candles, the technical analysis, everything that we do as traders is just our way of using tools and understanding to make sense of what's happening behind the scenes. Because at the most basic level, what's happening on any financial instrument that we see through a chart is buying and selling at various price levels. Demand, supply, having that exchange. When price rapidly moves from one direction or the other, what that means is there's an imbalance between supply and demand, and price needs to seek liquidity pools or large collections of orders to again rebalance price. Why? Because for every buy order, there needs to be a sell order on the other end. For every sell order, there needs to be a buy order on the other end. And it's that constant battle and that constant balance in the market is what causes price to move. So when we can understand from a conceptual standpoint where these large collection of orders are likely to be, we can understand why price is gravitating to them.